All right, we are officially live. We're gonna do small talk for like 4 minutes.
Yeah.
Say hi to everybody.
Is anybody
Um,
here? How do we know how many people are watching?
yeah. So I'm the only one that knows
Oh, cool.
because this is a platform that kind of like syndicates like all the different channels that I have going on from like
Uh,
YouTube, Facebook pages, and all that stuff, and it syndicates all in one place. But the admin is the only one that knows how many total. But through like
let's see.
throughout the other platforms, you'll see like one or two or three. But because
Uh-huh.
I'm actually on like about 10 different platforms, I get a collective of everybody,
The
and we
dashboard.
average about, I would say, like 80 people per
Wow.
room.
What's right now? How many people are
So
we
right
saying
now
good
we have
morning
10.
to?
Yeah, we have 10
10?
right now. Hey guys, for everybody that's joining us right now, let us know where you're watching from, so that way we can say hi to you as well.
Awesome.
But I want to ask some stuff, dude, because I've been watching some of your episodes, right? And so, like, are you gonna do a background on like how you got into notes? Because I
Yeah,
think
I have a slide. In
okay,
my weekly YouTube show, I never really talk about myself because it's just about the content. But today I have a slide just about me so I can share with those of you who don't know who I am or what I do.
because I remember you. I was like, I think you used to work for U.S. Mortgage
I
Resolution.
still I still work with U.S. Mortgage
Okay,
Resolution, and yeah, I was coming to your conference when it was an in-person event back in the good old days.
that was like 5 6 years ago. That's the craziest part.
Yeah,
But
time flies, man.
you know what? I gotta say something. Like, uh, I left the industry 5 6 years ago. Okay,
Really?
yeah, I got into notes probably like 7 8 years ago, and I left because I felt like I thought prices were going up to the point where it didn't make sense, you know. But
Specific
honestly
to
speaking,
notes, not real estate, right? You were still in real estate.
yeah, I was still in real estate. I was just not in. I thought like the note prices were going to go up to.
Hmm.
I mean, how much was it really going up? Like I was buying it for a fraction of what. Like I was buying for half of what it went up to. But
Hmm.
even at what it was selling for at that time, it was still a home run. You know.
Mm.
So, but for whatever
Yeah.
reason, I didn't realize that, and I just didn't raise any more capital for the fund I was involved with. They were still running and things like that, but I
Mhm.
think if I can just continue, I would like have a fund as the size of like Steve Lloyd, because Steve, he
Yeah,
was
yeah.
those. Like he,
Yeah, I had a similar experience because I started working in this industry in 2011, and then things kind of really slowed down. The pricing increased, and there wasn't as many trades in like 2015, 2016. And then I actually left U.S. Mortgage Resolution to start Fixed Notes, my own company. And then a couple years later, U.S. Mortgage Resolution picked up again, and they called me up, and they're like, "We need you back." So I stayed in the industry the whole time, but I felt that pain as well when things kind of crunched.
yeah. I kind of wish I just stayed, because I think
Yeah.
everything goes like I realize that everything goes in a cycle, and even when the cycle looks like it's gonna get tight in numbers, there's always like a new game that opens up or a
Mm,
new
yeah.
way of taking
You got to be
advantage.
opportunistic and quick moving to capitalize
Yeah,
on those opportunities.
yeah, 100%. Um, so it's 10 now. We have about 50 people actually on the
Let's do it.
stream right now. So Rob, I'm gonna let you take it over.
All right.
Um, So other than that, do you have a PowerPoint that's gonna come? Oh, you already
Yeah, I
know.
have some slides. I'm all set. And thank you, Nicole, for letting us know you're coming from New Jersey. Hope we get a lot of East Coast participants today. And feel free to leave any questions as we go in the comments. I'll try to address them, but if not, we'll get them at the end. I do have a presentation for you, and let's just get that going here. All right.
I'm
So,
here, so if you need.
all right. So I'll be in the corner here. Today's agenda. What are we talking about, guys? Well, first, I'm going to introduce myself. Like I told Nick, I don't normally, I have a weekly show where I don't normally talk about myself. I just talk about mortgage notes in the industry. But today's episode, since you guys might not know me already, I'm going to start with meet the host. Thanks, guys. Oh, that was a bunch of comments from Nick. Yeah, please. I see a lot of New Jersey, some Philadelphia. Yeah, leave a comment with where you're from, and then let's get to some questions as we go here. Another New York, New Jersey, Good stuff, guys. North Jersey sounding off. Definitely got a lot of New Jersey folks in this morning. All right, so we're gonna start with meeting me. Then we're gonna talk about a bunch of free stuff that I offer from my company Fix Notes. It's funny because we're gonna actually put the free stuff in the beginning of the show today, and then we'll get to the rest of the content. You don't even have to wait around to see all of the cool stuff I have for you. Then we're gonna talk about senior versus junior liens, which is today's primary topic. And then we're gonna kind of take that information and apply it into due diligence and pricing mortgage notes. And then finally, some case studies. We're going to review 1 first lien and 2 second lien case studies to apply everything we learned in the beginning of this program into context with some case studies. A bunch of New Jerseys, New York, Manhattan. Awesome, guys. Thank you so much for sounding off there in the comments. And like I said, please interrupt at any time to leave a comment with a question. All right, so let's get into the show. About me. So my name is Robert Maxwell Hytha. I'm a real estate entrepreneur. I've been in the game now for almost 10 years and have a bunch of different cash flowing types of endeavors that I pursue. First, I'm an investor with my personal portfolio. I own a coin-operated laundromat. It's been 3 years now, and that's been a really cool kind of surprise investment. We bought the building for its quadplex, and one of the units is a commercial space with the coin-operated laundromat in it. And we bought it because it cash flowed with these rental like the rental units above the laundromat. But the laundromat was kind of like a fun experiment, and my wife and I manage it ourselves once every other week, and it works out great. We really love being able to get away from the computer and actually do something with our hands. We've replaced plumbing over there, redid the flooring. I installed all the security cameras. So that's kind of a nice change of pace because in the note business, as you'll see, we spend a lot of time at the computer in front of a spreadsheet. So I also own single family rental properties, and that's also self-managed. And I'm very fortunate to have great tenants, so I don't have that much that actually needs management in my portfolio for rental properties. I also have a self-directed IRA where I hold reperforming loans, and then I also buy strategic non-performing loans. And I specifically call it strategic NPLs because I do not have a non-performing loan business where I'm working out loans for my own portfolio. I do that for my clients, but because I have access to large portfolios of notes that I manage, it's kind of a conflict of interest, adverse selection if I were to buy loans from my clients' books. So I make it a practice not to buy loans from the portfolios that I put out to the market for sale from my clients so that my buyers have that first pick. I'm not cherry picking things that maybe have some inside information. So the strategic NPLs that I do buy are from relationships outside of my primary clients who I sell loans for. And I most recently bought a loan 2 months ago, actually a month ago now, in the same town as all of my rental properties. So that's why I call it a strategic NPL, because it's actually going to become an REO, and that'll be a rental property someday. So I'm an investor. I also own a company called Legado. Legado is a word that means legacy in Spanish. So I'm actually partnered with a bilingual Hispanic partner, and we split this portfolio and buy rental properties. So we don't have any debt. I really like using debt for my personal portfolios. I mean, interest rates are historically low, and you can leverage fixed rate mortgages if you have the cash flow for 30 years to capture that appreciation of the property and potentially inflation that's going to make your mortgage loan pretty much free if you're 3-4% interest rates. But in Legado, in this company, we have no debt whatsoever, and it's a turnkey rental portfolio, so everything's with a management company we pay 7% to. And I'll give you their name. It's Slate House Group. Slate House Group actually spoke at an event in Philly pre-pandemic, so you might know them if you were at the Atlantic, the Tri-State Mid-Atlantic Real Estate Conference, I think it was called. So they're really expanding and great company, I found at least. So Slate House Group manages that portfolio for us. Then finally, I'm with U.S. Mortgage Resolution. So I am the National Director of Sales and Acquisitions still with USMR. I started back in 2011 and have really learned the business with them throughout these last almost 10 years now. So before I joined them, they had just started and had just moved into a corporate space. The founders, Tom Dunkel and Joe Downs, and they had acquired about 46 assets, 1.6 million in UPB. And then I came on and started reviewing collateral files and calling investors and managing their portfolio, little by little, gaining more responsibility as I made myself indispensable. And with me, we went on to acquire over 10,000 assets, 400 million plus of unpaid principal balance. I've reviewed $1 billion plus of real estate value in the course of my tenure with USMR. So in 2016, 2017, USMR, the principals there were kind of focusing on some other opportunities, syndicating big rental apartments, and doing some self-storage investments and some other avenues. Because the note business, as Nick mentioned in our intro here, had kind of changed in that time around 2016, 17. Pricing was going up. There weren't as many deals. But I decided I wanted to stay in the industry. So I started Fixed Notes. And Fixed Notes was my way to build a brand in the mortgage note space, to attract other clients and then actually build an expertise so that when U.S. mortgage resolution came back into the game after they saw more opportunities coming back to the mortgage note business in 2017, 2018, and then 2019 and 2020, we've just been on another upward trajectory with them. And it's been great because I got to write my own ticket, having my own brand. When they came to me to hire me again, could kind of reassess our consulting agreement there. So that's kind of the business side of things. I put a bunch of fun little graphics together to show you the personal side of things pretty quickly here. So I love sports. My wife and I love playing tennis, love tossing a football. I actually prefer playing sports to watching sports. I know some people have a different perspective there, but I like to get out and move. I also, and you'll see this if you know my YouTube show, but love bird watching. I actually have a bird watching camera set up right now. There's a live feed. And behind, you'll see if he comes around, I'll try and scare him over. Come on, dude. No, he flew away. That was a white-breasted nuthatch. I also am a musician. I play a bunch of different instruments, a couple there, saxophone, guitar, and hand percussion, some of my favorites, some saxophones right there. My mantra with music is to try to play all of the related instruments. So I've got every version of the saxophone almost, clarinets, flutes, guitar, mandolin, string instruments, and woodwinds. Try to learn all of them. Especially being in quarantine, we got to challenge ourselves and keep things moving. So I love music. The next thing here is a tree. I love trees, climbing trees, gardening. My wife and I moved into this property in January, and the surrounding nature is just wonderful. So it's a big part of my life now that I live out of Philadelphia. I was living in the city. Now I live in nature, which is beautiful. There's also a koi fish because we inherited this koi pond when we bought this house, and I didn't even know how much I would love hanging out with these fish, but that's a fun part of my life now that we live here. And finally, a skateboard, because I love skateboarding. If you guys have seen my personal YouTube channel, the only videos I have are back in college doing skateboarding tutorials. So just to explain that. And finally, YouTube. I love learning new things on YouTube. And then I also have a YouTube channel. So Fixed Notes, and oh yeah, the bird is playing saxophone. So Fixed Notes has evolved over the last couple of years, since 2017 when I founded to now in the last 20 weeks or so, I've created this live YouTube show called Be the Bank. And a lot of the content from today's episode is, oh wait, are you guys not even watching my bad. You guys got to tell me in the chat when something like that happens. Let me go back. Here's all of the things. I'm already screwing up, everybody. I'm sorry. So there's the slide that you missed, and there's all the fun stuff. And there's the bird playing the saxophone. Okay, now we're done with that silliness. So Be the Bank is my live YouTube show. I present it every single Wednesday at 1 o'clock. Next episode is this coming Wednesday, the 14th, episode 18. And we cover so much stuff in the show, industry overview and news, tech tips, vendor reviews, assets for sale, case studies, giveaways. It's all free and it's all on YouTube, so definitely check that out. All right, let's get to the content. Enough about me, enough about my company. Oh wait, there is two more things about the company. This is free stuff. Fixednotes.com/news is an industry news aggregator. I use an RSS feed to put together a whole bunch of content that's coming out on a regular basis around the internet. So you can check out what's going on in the industry over at fixednotes.com/news. And then finally, fixednotes.com/learn how to invest in mortgage notes. 100% free. It's all online, and you can go through these modules and learn the business at your own speed. It's all free, so definitely check it out. Here's some of what you'll learn in that course. It's broken up into these 6 modules: getting started, the market, due diligence, closing the deal, asset management, and then some bonuses. Totally free. Check it out. All right, so let's get into the real show here. First versus seconds. So senior liens versus junior liens. The first thing we're going to talk about is the due diligence expense. First liens, you're typically going to pay $250 to $500 in due diligence to review a first lien. And junior liens, on the other hand, $50 to $200. So what makes up that massive difference in the pricing that you're going to see when researching? Well, for senior liens, I don't really recommend pursuing a senior lien without ordering title and a BPO. Title and BPO alone, that's about $200 worth of your due diligence expense. Whereas with junior liens, a lot of the time, because you can buy a larger portfolio, you can diversify more in juniors, you opt to not order title or BPO. And we'll get into some more reasons why that is the case. But the high level reason, maybe it's the next one. No, it's the following point. We'll get to it in a minute. So senior liens can be wiped by taxes or the homeowners association in super lien states. Junior liens can be wiped by the taxes or the homeowners association or the senior lien. So right now it kind of looks like seniors have somewhat of an advantage there because you're not junior to a lien, another security instrument in front of your lien, in front of your debt that could potentially wipe you out. Well, in reality, the junior position has a bit of an advantage here because if you are behind a senior lien who's not asleep at the wheel, the senior lien holder is going to be the one monitoring taxes, making sure the homeowners association bills are paid. Typically about 95% plus of senior liens escrow taxes and insurance. So if the senior lien is current, the taxes are more than likely current as well. In junior position, I like the fact that the senior is kind of blocking and tackling in front of you to make sure that those senior priority liens like taxes or homeowners association are not going to affect the enforceability of my junior position lien. When you buy seniors though, you need to be on top of things. You need to be monitoring taxes and the homeowners association bill if you own a non-performing senior lien, because the borrower, they're not paying you, they're not getting their taxes and insurance escrowed. And if their homeowners association is past due as well, there's certain states, these super lien states, where, and I don't want to click this because my presentation, well, let's just try it. Here's the super lien states. Oh, and there was a skateboard on the screen. So these states in blue are the super lien states where your homeowners association can actually get in front of a mortgage loan, even if they were recorded after the fact. So in order to get to that point, though, a homeowners association would not only have to be past due, but they'd also have to file a lien and record that lien in order to become a priority lien to the senior. So that's the main reason why I like juniors. Not only is the due diligence less expensive, but it's actually less risky because you can use the status of the senior lien to telegraph to you whether or not the taxes are current, whether or not the homeowner wants to stay in that property. So in junior liens, the due diligence process is pretty straightforward by looking at the senior. All right, so next is property-centric resolutions versus borrower-centric resolutions. So senior liens are more often than not resolved through the real estate, resolved through the property. And that's one of the reasons why I recommended always ordering that BPO, the broker's price opinion, when you're looking at senior liens for purchase. Because in senior position, if you end up with the home, you need to be ready to take back that property and understand that the collateral value is enough to support your investment. That also means, though, that you need something called forced place insurance. So insurance, obviously, it's escrowed when the borrower is paying the mortgage and if things are working out. You escrow taxes and insurance, the property is insured. But if the borrower is not paying the senior, the property is not insured, you need to put in place forced place insurance, which is basically a lender's way of insuring a property without the borrower's effort. You're, as the lender, putting the insurance policy in place yourself. And just the same, when you get a deal done with a borrower, you want them to add you to the property insurance policy. So hopefully you don't always have the forced place insurance and you can have a borrower get their own insurance policy once a loan is paying again with the lender as additionally insured. Junior liens, on the other hand, more often than not resolve through the borrower. And that's why we call something, we call it emotional equity. But even if the numbers don't work on paper, junior liens can sometimes be great opportunities to resolve a deal with the borrower because the borrower is living in that property, assuming it's owner occupied, and they want to stay there. They've got emotional equity that can't really be quantified, but it's important to them that they make their bills current again and stay in that property. Whereas in seniors, at least a lot of the seniors that you'll see trading on the market are lower value homes that don't typically have a lot of emotional equity, and you'll see more, and this is rare, I know it's something you see in the news, but strategic default, where a borrower purposely stops paying their loan, lets their credit get shot, goes to bankruptcy to resolve their debts in full. So that happens more often in senior liens. As rare as it might be, it's happening more often in senior than junior liens. And we do see juniors resolved through the borrower a lot more often than seniors. So finally, senior liens are more expensive to get the same, well, it's actually a lower quality collateral. If you're gonna pay the same price as junior liens, buying a senior lien, you're gonna end up with a property that's a much lower value for a similar price. Whereas in junior liens, you've got much greater discounts. It's easier to diversify, and you're kind of leveraged, because if you're buying a junior lien by definition is the second lien on a property. So if a property is actually enough value to have two mortgage liens on it, then you're probably dealing with a higher value home. Whereas if you buy senior liens, it's the only lien on the property. Typically those do not have junior liens attached. There's sub $100,000 homes, and it kind of creates some additional issues and challenges to overcome in the resolution process. The higher value homes that you would be secured by in junior position are normally better maintained, in better neighborhoods, and often are more sophisticated borrowers than those low value homes. But you can buy higher value senior liens. It's just you're going to be paying way more for a similar quality collateral at the end of the day. All right, so let's move on from first versus seconds into pricing. So this is a high level overview of the fourth quarter market pricing. And the reason I put the slide up, because it gives us an opportunity to describe some of how seniors and juniors differ with regards to the valuation. So let's start off in this top left quadrant, and we're going to talk about performing loans and non-performing loans today. But over here we see performing valued as a percentage of yield. So these percentages are the cash on cash return that you could expect to generate by purchasing a reperforming senior or junior. Now I know it says performing, it's cash flowing, that makes it simple, but really in this business, we're talking about reperforming debt, loans that were once non-performing and in default and have now become performing. So seniors as a percentage of yield based on their cash on cash return go from about 7.5% to 12.5% roughly. And that's going to be the annual recoup of your investment. So if you buy a senior lien and get a 10% yield just about, and you spend $100,000, you could expect to get $10,000 a year. And that would be a pretty fair yield, 10% cash on cash return for senior liens. Now you need to make sure when you buy senior liens or performing loans in general to make sure that your purchase is capped by the unpaid principal balance, because you're never going to receive more than the unpaid principal balance plus interest. So in addition to looking at the cash on cash return, you also have to look at the internal rate of return. And in my weekly show on YouTube, I've provided a bunch of spreadsheets and investment calculators which you can use to calculate internal rate of return. That's all free as well. There's Dropbox links in the description on the YouTube videos. So just look up Fixed Notes or my name on Google or YouTube and you should be able to find it. Junior liens, the yields are higher. Another reason why I really like junior liens, because like you kind of think at first it's riskier because it's behind a senior, but if you buy right and you have equity, it's just as safe as a senior and the yields are stronger. So in junior position, we're talking 12% to maybe 22% yields. That's the cash on cash return you would generate purchasing a cash flowing junior position lien. So let's go over to the non-performing side now. And first look at senior liens. Non-performing seniors are valued as a percentage of fair market value. And that's because, as we discussed, seniors typically resolve through the property. And you need to be prepared to take back the property buying either senior or junior, but more importantly, senior. So we really speak in terms of fair market value when valuing senior liens. Once again, you got to make sure that those numbers are capped by the UPB. I don't think you'd want to pay more than 75–80% of the unpaid principal balance in a junior or in a senior lien position, but you can pay over 80%, sometimes 85–90% even, as percentage of fair market value when buying non-performing seniors. So these numbers on the side here, these are the changes that I've seen in the market since last quarter. I didn't sell a lot of performing loans, so I couldn't really speak to the changes in price there. But I did see pricing actually decrease for seniors and juniors in the last quarter by 99 basis points, which is about 1% for seniors in the upper end, and 112% for juniors in the high end percentage of UPB. So let's go on to juniors here. They're priced based on the percentage of the unpaid principal balance, because juniors, more often than not, resolve through the borrower. So we need to make sure that when we're valuing based on the unpaid principal balance, that we make sure that our numbers are within reason for the opportunity. So with juniors, and we'll talk about this in the next slide, you're really looking at two major things: the senior lien status and the equity. And based on those attributes, if it's senior current and full equity coverage, you're going to be looking at the upper end of this range. Whereas on the opposite side, if the senior is pending foreclosure and there's no equity, you might price that as low as 4% or even less, depending on how close to being unsecured that loan is. So any questions, please leave them in the comments. This is the Q4 market pricing as I see it. In this last Q3, we sold over 100 loans. So we've got some kind of triangulation on the values that we're seeing in the marketplace. And I'd be happy to answer any questions at all that you have about these. All right, so let's go on to the next slide here and talk about the non-performing waterfall evaluation. So this is how we can really go from having a blank data tape, and I say blank, but you've got the seller's data, but you haven't added any of your own data when you're doing due diligence. Going from that all the way to the point where you have complete pricing analysis and you've sent that into the seller to get a trade done. So we're looking at this from the perspective of a non-performing mortgage note investor doing the research to acquire. We'll talk about it in terms of a one-off loan. So they're looking at a loan. The first thing you want to do is confirm whether it's secured or unsecured. The largest driver of price in this business is going to be secured versus unsecured. And that is because the security instrument, the mortgage that attaches the debt to the collateral, is what gives the borrower or gives the lender the enforceability through foreclosure. If you do not have a secured lien, then you do not have any opportunity to enforce through the collateral. And the way we determine whether or not it's secured versus unsecured is pretty simple, but it can get more complex. At the very highest level, you're confirming that the owner of the property matches the borrower's name on your data tape, on your spreadsheet of available inventory assets. So if you see that John Smith is on the data tape as the borrower, the one who owes the money, and then you go to the county records and you pull up that property in the tax assessor's page, for example, to see who's paying the taxes, and that's same guy, John Smith, then you can confirm that the loan is secured, because the guy who owes the money also owns the property. The collateral is still secured. Now that's a little bit oversimplifying it, because if, for example, there was a satisfaction of mortgage recorded for the subject lien that you're looking at, that would wipe the debt. It would be unsecured even though the same owner still is on title. But we can do a little bit more research through the property county records and checking the deeds at the recorder's page to see what documents have been filed in the public record to determine whether or not it has been satisfied. Although I will say, when you're buying a loan, you will most likely have reps and warrants, representations and warranties that protect you in the event that a loan was misrepresented as secured when it was actually unsecured. So once you've determined that, you kick out the unsecured loans if you're not an investor who's interested in that subset of this business. Now, it does have a value. Everything has a value, and unsecured loans are priced anywhere from 0.5%, 50 basis points, up to 5% of the unpaid principal balance. So the last unsecured trade I did was about 3 weeks ago, and we closed, I think, about 20 unsecured loans for 1.9% of the unpaid principal balance. So that was a little higher than you might expect, and it's because of a couple things. One, unsecured debt that was originally originated in a mortgage is more valuable than unsecured debt that started as credit card debt or other unsecured originations. When you're buying unsecured debt that's originally a mortgage, it's typically with a borrower who is more sophisticated, a little bit higher FICO scores at the time. They were qualified for mortgage. They have assets to acquire, and they've also sometimes have other assets that can be pursued through the unsecured process. So garnishing wages, through a judgment in the unsecured side. But we're going to focus on the secured side. I really, truly believe that that's where we can have the most value we can add as investors. Because at the end of the day, this is about helping the borrowers, helping them come to some resolution to an otherwise difficult situation. And there's win-win, 3 wins actually. We win with the bank because we acquire their non-performing charged off portfolios, so we can help them clean up their balance sheets. It's a win with the borrower because we're able to offer them discounts and get a non-performing loan paying again. And it's a win for the investor because you're able to buy at a discount and then turn it into a modification, a cash flowing loan, or a discounted payoff at a profit. So we're going to stick to unsecured. Sorry, we're going to stick to secured because that is really the best place to help borrowers in this business. So after that, you're determining one or the other direction. Is it a first lien or is it a second lien? So you can do this research all on your own if the property is in the public records. If the county is giving you all of the deeds and other recorders information, and you can search that online, you could do your own title search by looking at all of the recorded documents that are secured by that same property and seeing, based on the date of origination, which lien is senior, which lien is junior. So with one caveat, the date of the recording of the lien is the date that creates the priority. And the priority is senior or junior. So the first loan that's recorded is in senior position. The one exception there is if there is a subordination agreement. If a senior lien is originated after the junior, for example, let's say you refinance your first position mortgage and you have a second already on your home. A contingency of that origination is having a subordination agreement signed by the junior lien holder so that the junior lien holder puts themselves back in second position and the first lien stays where it is in first position. So there could be other liens as well that you'll see in that report. And like we talked about in the first slide about the super lien states, homeowners association liens, even if they're recorded after, can be treated as priority in those blue highlighted states on the map we showed you. But in general, you should have a pretty straightforward time seeing which is first, which is second. So on the first lien side, as we discussed, there's typically values between 5% and 85% applied to the fair market value. And we're going to talk about the value bands in the next section and how really roughly each one of these different value bands corresponds to a different percentage of the fair market value. But I did see a question, any concerns between recourse and non-recourse states? I'm not going to get into that in this episode. We're keeping it kind of high level, but we do go into a lot of detail in the YouTube show with regards to judicial versus non-judicial, recourse versus non-recourse, all of these different considerations for geography. But right now we're looking at it kind of from a holistic perspective, nationwide, not specific to geographies, other than with regards to the county records being available online or not, which is kind of spotty depending on which jurisdiction you're looking at. But I would recommend, if you are doing due diligence for the first time, maybe you're not even ready yet to buy a loan, but you want to go through that as an exercise, I would recommend reviewing loans that are in counties that have public records, the deeds online, because then you're going to be able to do all of the research by yourself. You're not going to need to hire a title company, but you'll be able to review your own title report using those public records just as a good practice. Now, if you don't have access to the public records, there's a really cool trick. And I love Pro Title USA, and Alex Goldovsky is great. And he actually has a really cool tool on his website that's free. If you go to protitleiusa.com/order, you can start completing an order for an O&E report by putting in the property address. And that property address in the next screen will actually have a summarized ownership record. So before you even press order to buy your $90 O&E ownerships and encumbrance report, you can actually see the vested owner on title per Pro Title's. They've got like an automated service, and it's about 80% successful in telling you who is the owner of the property, thereby letting you know in the beginning whether it's secured versus unsecured. So that's a really useful tool, protitleiusa.com/order, to get a owner name without even doing anything other than typing in an address. All right, on the second lien side, we're pricing between 2% and 60% of the unpaid principal balance. And that's a high range, and it's interesting that even at the low end here at 2%, that can be less than an unsecured debt. And the reason is, in second position, if you have no equity whatsoever and it's on the fast track to foreclosure from a senior lien position, that loan is almost as good as unsecured, even though it's not technically unsecured yet, because there is no equity protecting the junior lien. It can be priced nearly as unsecured. Now, we'll move down into the next bucket, which is value and equity. So senior liens are priced based on these value bands, and we kind of stratify them into these value bands because there's a very, very big difference between these lower value homes and the higher value homes with regards to emotional equity and the borrower's intentions and the upkeep and maintenance of the properties. So typically in the lower end, 10,000 and less properties, we see a lot of vacant land in that bucket. And those are priced as a percentage of value very, very low, at 5, 10, 15%, sometimes more with the vacant land because it's not as much of a liability as a property that maybe needs to be torn down. With the land, you see is what you get, and it's vacant. Now, as you move up the value bands, you see increased percentage of that value as far as the pricing. So when you get up to 100,000 and up, that's where you're really seeing premium values for senior liens. And I cap it, my chart here at 85%, but really you could see 90% plus of the fair market value when looking at equity senior liens with higher property values. So with these value bands, typically I will net the property taxes and any homeowners association dues, anything else that is senior to you in first position. The value band is really related to the equity. So I think just as a rule of thumb, $50,000 property, well, we'll call it a $60,000 property with 10,000 of arrears in the taxes, and the homeowners association with 50,000 of equity is worth about 50% of the fair market value. So based on the unpaid principal balance and making sure you don't pay more than the UPB, that's kind of a good place to find a middle ground. At 50K equity in a senior lien is worth about 50% or $25,000 with that UPB considered. On the junior lien side, it's all about the equity. And there's a couple ways to calculate equity. Some are from the borrower's perspective, others are from the investor's perspective. So when we talk about combined loan to value, CLTV, we're talking about the equity from the borrower's perspective. What is the value of the home minus all of the other liens that that borrower has? But when we're talking from an investor's perspective, buying a junior lien, we like to use the term invested capital to value, ICTV. And ICTV is cool because instead of using the junior lien in that CLTV equation, we use the purchase price of the junior lien. So instead of a CLTV that might be above 100% because the borrower technically does not have equity, if there was a little bit of equity above the first lien, the LTV, just the loan to value, and it was enough equity to pay your investment, your invested capital, and then some, then you actually have an ICTV that's less than 100% and therefore a more attractive asset. Even if it doesn't look like equity from the borrower's perspective, as a lien holder, you can offer the borrower some discounts to get them to a good equity position and also have enough to make a profit on your investment. So once we've talked about value and equity in junior lien by looking at the first lien balance from the credit report, and I didn't add a slide here, but maybe if we have enough time, I can unhide a slide with some considerations for credit reports and how to review the trade line on a senior lien for a junior lien acquisition. But from there, we'll go to bankruptcy. So when you're looking at bankruptcy as a lien holder, at first, or a prospective lien holder, at first it may be a little bit intimidating and a little bit of a confusing additional learning curve because bankruptcy, everything needs to go through the courts. There's a lot of new words that you're going to learn, and it becomes a little bit more confusing. But when you sort through the verbiage and the legalese, you actually get into a position where it's less confusing. The bankruptcy, the whole point of it is to reveal all of the borrower's financials so that the lender and the other creditors that are owed can come to some agreement with the borrower that makes sense for everybody. So you want to look at the chapter and the status because there is a risk in Chapter 13 bankruptcies of having a lien strip and being wiped out if you do not have any equity as a junior lien holder. Whereas a senior lien holder, you want to make sure with the chapter and the status that you're moving forward in a direction to start collecting payments. And the way you do that after you've determined that it is a bankruptcy account is to pull up the voluntary petition, which is the first document that's recorded in the bankruptcy proceeding that gives the borrower an opportunity to share all of their financials. So in the voluntary petition, you'll find a Schedule D, and Schedule D is the secured claims of the creditors. I think Schedule C is the unsecured claims, or maybe that's Schedule E. But in any case, you want to see Schedule D because that is secured claims. And this is a great little chart you'll see because it will not only include all the property that the borrower owns and all the values that they think that those properties are worth, but it includes the lien position and the lien amounts of all of the outstanding debts secured by that property. So on the voluntary petition, if you see that a junior lien is marked as wholly unsecured, meaning there is a very high percentage CLTV, and even worse, there's a high percentage LTV. So that means the senior lien is actually higher than the value of the property. In that position, the junior lien is wholly unsecured, and the borrower can file a motion to strip the lien. And actually, once that bankruptcy is discharged, the lien becomes uncollectible. Even if it was unsecured in bankruptcies, you also get wiped of the personal liability of any debts. So even if you were moving in the position of having an unsecured debt, it is no longer collectible in any way once a bankruptcy is discharged. However, if the bankruptcy is dismissed, all the cards are back on the table. And in that case, a wholly unsecured junior has another shot because the lien has not been removed from the property yet if the bankruptcy was dismissed or otherwise thrown out. So voluntary petition, one of the most important things you'll see in the bankruptcy docket, but you'll also want to look as a junior lien holder for a motion for relief from stay. So it's interesting in a bankruptcy because it pauses any sort of legal proceedings that are happening with regards to a home. And if and it's called the stay. A stay is where foreclosures are put on hold. Nobody's foreclosing. We're going to go through the courts and figure this out. But a motion to relieve that stay is a lender's way to begin the foreclosure process when a bankruptcy has taken place. So if you see a motion for relief from stay in the docket as a junior lien holder, you want to make sure you open that document up and see if it's referencing the senior lien secured by the same property that you're secured by, because that means that now the senior, even though it's a bankruptcy account, the senior is pursuing that foreclosure, and it's another way that you could potentially be wiped out as a junior lien holder in bankruptcy. So it's great in bankruptcy because you can see the equity through that voluntary petition, Schedule D, and it also does put the borrower on a track to resolve the debts. If you are unable to reach a borrower, a non-performing loan, to get a deal done, and you see that borrower files bankruptcy, then at least the issue has been forced and you're able to work with the courts to come up with a solution. So after bankruptcy, and it's in this order, but honestly, occupancy is one of the first things I'm going to check. Occupancy is super important because it does determine the borrower's ability for the emotional equity. If this is their home and their community, and they live in the subject property, it does have a big impact on the borrower's willingness to come to some resolution. Occupancy can be determined through a variety of different sources. Right off the bat, we talked about checking the property records, the tax assessor's records at the county, to determine whether or not the owner name matches the borrower name. When you're at it, you can also look at the mailing address where the tax statements go for the subject property. If the mailing address matches the property address, then you know it's owner occupied. Whereas if that mailing address is a different address, then it's more than likely the borrower's primary residence, and the subject property could be vacant or tenant occupied or otherwise not occupied by the borrower. So we also look at credit for occupancy. Credit reports include 3 different addresses, and the first one is the most current address. So that's another way to triangulate the occupancy status. The skip tracing report is probably one of the best ways to find out. If you run a skip trace on a borrower, you can see through their utility records where they're living. So it's a third way to triangulate the occupancy. And then finally, and this is only once you own the loan, but the most accurate way to determine occupancy is with a door knocker, to have somebody on behalf of the lender or the servicer go to the home and either serve them papers or have a conversation. There's some door knockers who will actually do a warm transfer, and they'll get the borrower on the phone and then transfer it to the lender if the lender's been unable to communicate with them otherwise. But once you have those data points in order, before you get to the door knocker, you can determine by triangulating the different statuses from the different sources whether or not, with a high degree of probability, the borrower lives in the subject property or not. And of course, things like Google Street View are very good, but make sure when you're looking at a Google Street View, you look near the bottom to see the date that that street view was captured. Because if it was 3-4 years ago and the property looks great, it may be dilapidated 4 years later, and you would be unknown to that without a current image of the property. Okay, so once you've reviewed occupancy, that's helpful in first or seconds. Whether or not the borrower lives in the home is a big driver of price and of the viability of the future resolution. Then we move on to a split decision here between first and seconds. So as I mentioned with first liens, the title report is super important because you need to determine whether or not there's back due taxes. Pro Title USA's O&E report does include past due taxes. And if there is any potential liens senior to you, they will show up on the title report. So other liens and judgments, and then the assignment chain on the title report, super important to make sure that the seller of the lien that you're purchasing is recorded on title as the current assignee, and that they are authorized to prepare another assignment to record to put you as the assignee vested in that mortgage note. So title, super important, and then taxes. So looking at the status of the taxes, the balance, so you can determine your equity, the redemption deadline, if the taxes have been sold, to determine whether or not you have the opportunity to pay them off at some point, or making sure that you have that deadline in place so you're not losing the opportunity to enforce your lien on the secured collateral. And then on the junior lien side, first lien status and equity are the most important things for pricing after secured versus unsecured. The first lien status is going to be maybe the first thing that a lot of junior lien investors are going to look at to price their assets. And that's going to be a status of foreclosure, foreclosure collateral sold, foreclosure initiated, delinquent 120, delinquent 90, 60, 30, up to what we call rolling 30 or rolling 60, which is a status that means that they're consistently a month behind, but they are consistent. Or finally, current or as agreed, meaning that they're making their payments on time every month. So the way we do that with the first lien status is to look at the payment string. And it's a series of numbers of typically 12 to 24 numbers, starting with 1 for current. So a bunch of 1s would mean that the borrower is making their payment every month. 2s are 30 days late. A bunch of 2s would be rolling 30. 3s would be rolling 60. But if you see something like 1, 1, 1, 1, 1, and then it goes, well, it's actually in reverse. So let's see, we see 4, 3, 2, 1, 1, 1, 1, 1, 1. That would mean that the borrower is on a downward trajectory. They were making their payments every month, and then they got 30 days late, they got 60, they got 90, they slowly were slipping off. So you can really create a picture of a borrower by looking at the credit report and looking at the various trade lines to determine not only what kind of lifestyle they live, what kind of cars they drive, if they're financed, if they have medical debts, if they have a bunch of credit cards, if their mortgages are paid on time, and then most importantly for the junior position debt, whether the senior lien is paid every month. So that's going to be how you determine the equity by taking the balance of the senior and deducting the fair market value from that number to come to the loan to value percentage. If the loan has positive equity, it's going to be priced higher. If it's lower equity, you have to take into account those risks and price lower. So that's a high-level overview of the waterfall evaluation for non-performing loans. Please leave any comments. We're getting to the end of the session here. It's 10:45. I think we're wrapping up in like 5 minutes. So please leave any comments that you have. And of course, if you want to get more detail, these are some of the slides roughly that I present on my weekly show with a lot more detail on YouTube. So let's see what the next slide is. I think this is it though. Thanks for watching. Oh no, it's the same again. Just give you a high-level overview if you missed the first time around. This is the first versus second slide to give you just that high level of what to expect as the differences between seniors and juniors. Yeah, feel free to leave any questions at all. I'll be happy to discuss them now that we've went through the slides. And thank you for watching, guys. Oh wait, case studies. Oh my gosh, we don't have much time left and we got all these case studies. All right, we're gonna fly through these. So the first one's a non-performing first lien secured by a single-family residential home. We received a full payoff on this account, and you'll see why. Because there was a ton of equity. The fair market value is $90,000, no delinquent taxes. That leaves $90,000 of equity, protecting $6,146 of unpaid principal balance. This is a no-brainer. You wouldn't really see this loan for sale that often unless it was the an investor, a a portfolio that really needed to liquidate. Otherwise, this deal is going to be paid off inevitably. So we ask 3 questions when we get in touch with the borrower. What happened? Where are you now? And what do you want to do? And those 3 questions help frame our conversation to determine a resolution that is a win-win. Because the only way I believe to effectively run this business is to be working in the borrower's best interests. And if the borrower is uncooperative, sure, you can enforce through foreclosure. But if you're able to work with the borrower, then you want to make sure that you create a resolution that fits their needs. So in this case, what happened? They got behind on their loan, but they kept up with the taxes. Where are they now? Well, it's owner occupied, but the property is on the market for $84,900. They are ready to sell. They want to settle the debt and move to more affordable housing options. I received an email from title in July to prepare for the loan sale. And then closing a little bit later was set for August, and a payoff quote was requested because we had that closing date set. We sent over the servicing payment details. We sent off the payoff to title for closing. And then what do they want to do? They want to close the sale of the home and settle the debt in full. I have a question here. Offer them cash for keys if they're non-performing. Absolutely. You can absolutely offer someone cash for keys in a non-performing loan situation, and that could be in the borrower's best interest. And obviously that would be in the lender's best interest in this account, because we are only owed $6,000. If we were able to acquire the deed for a $90,000 home, that would have been a big win. However, that's not in the borrower's best interest, and the borrower clearly understood that they had plenty of equity. So that's exactly a good example of where, as an investor, you need to align your interest with the borrower. If you were trying to force either a foreclosure or a deed in lieu or cash for keys to get back the deed to the property, you would be in a significantly uphill battle with the borrower, fighting them for their equity. They own the property, it's their equity. We want to be supportive as a lender. In this case, get the property sale done. So this non-performing loan only cost $3,600, and we capped it at around 60% of the unpaid principal balance. It was purchased in a large portfolio, so this wouldn't be expected as a one-off deal. In fact, I would never even imagine seeing a one-off deal like this on the market because so much equity, it's going to get paid off pretty easily. But because it was purchased in a larger portfolio, it went for $3,600. And over the course of 11 months, to go from start to finish and $620 of expenses for due diligence, onboarding, and collections, we reached a payoff of $6,927, which was the unpaid principal balance plus the arrears on the account. So a couple takeaways from this case study. 1, send monthly payments to establish urgency and account for the arrears. So when you first acquire a charged-off loan, there will not be any arrears accumulated by the previous lender. Once a loan is charged off, they're not sending statements anymore, and there is no continual monthly accrual of interest. But once the loan is re-engaged with the servicing, you can start sending those monthly payments to evidence the increasing arrears balance, establishing urgency for the borrower to get their payment in and get the deal closed, either whether it be a modification or a payoff. Now, the next takeaway is to encourage a resolution that most benefits the borrower. We already mentioned that. Next is to monitor property taxes for borrower intentions and the risk to the first lien. In first lien position, taxes are kind of like the senior lien when you're in a junior lien position. And because we saw 0 in taxes, we knew the borrower intended on keeping the property, or at least keeping up with the property. In this case, they sold it, but they made sure the taxes were paid every year. And then finally, the velocity of money. A payoff offers a much higher return in terms of the internal rate of return than a modification. This would have been a nice deal because with all that equity, we could have started receiving a monthly payment every month. But you're not going to see those internal rate of returns that are 100% plus until you actually get your cost basis back plus interest plus arrears and achieve that internal rate of return, which is a lot higher. The time value of money makes a huge difference, especially when you have more opportunities to deploy that capital into. You can turn that capital over a couple times a year. In this case, it took 11 months, so we could at least get our next acquisition rolling a month earlier than a full year turnaround. All right, so let's go on to another case study here. This one's a non-performing second lien. We're going to do 2 second liens. This one's also secured by a single-family residential property, and we achieved a discounted payoff for $4,000 on this account. So the fair market value is $120,320. Senior lien's unknown. Equity then is unknown as well. If you don't have a senior lien, active senior lien trade line to review, then you can't really determine the equity. But what we do in those situations is look at the senior lien origination amount to give some calculation, give some number into our calculation to determine what the equity might be. Now, the senior lien could be owed more than the origination balance, but if it's been originated in the past, it more than likely is less than the origination balance. So it's one way to determine a rough equity, a summary, like just, you're not going to get exactly there, but you can at least plug in something to run your calculations. So what happened? Where are you now? What do you want to do? Well, with this borrower, they were divorced to the co-borrower. They lost track of the account, and it kind of became a headache for them. But the co-borrower was actually still living in the subject property, and the borrower here we were in touch with wanted to pay off the loan. So it was contingent on the borrower's acceptance of this generous divorce terms. And I was totally in agreement with the borrower that this was generous. He was paying off the mortgage secured by a home that he wasn't going to own anymore. His wife was going to get that in the divorce. So 3 months later, I had no communication with the co-borrower, and that initial offer that we provided to them, $1,000 discount to settle the debt, had expired. So 5 months later, there was a different property refinance closing, and the borrower said, I'm ready to pay it off. But at that point, we can't accept that $3,388 settlement. We increased it to $4,000, and we're ready to accept it following the refinance. So this one was priced at pretty high, at 45% of the unpaid principal balance. This is more of a one-off number for an unknown senior lien type of account. But because of the potential for the equity, this was priced higher based on that origination balance of the senior. It took 9 months in this case and $215 of expenses to go from due diligence, onboarding, and collections to achieve a payoff of $4,000, which was 91.1% of the unpaid principal balance. We did offer a discount here and then increase that discount later, but still had over $300 of discount available to the borrower to get this done in a quick and easy way. And that was a successful approach on this account. So some takeaways: establish rapport with your borrower, empathize and encourage that honest conversation. You really want to be their advocate because at the end of the day, you want to make sure that when they have any developments or updates, they're going to be calling you right away to provide that update to you and keep moving in the right direction. To keep moving in the right direction, you need to stay vigilant, set dates, and follow up with your borrowers. If you say you need to call me next Friday and they don't call you, then you need to make sure that you're following up with them to tell them that they missed a deadline, and it's going to be an important thing to address if they want to get the best possible resolution on the account. Expired discounted payoffs need to be increased to establish urgency. If you offered a discount previously, and they missed the deadline, you could either take that discount off the table altogether or increase the discount, well, the opposite, increase the payoff to reduce the discount to make sure the borrower understands that if they do not pay off the loan as agreed, the amount does increase. And then finally, the velocity of money. We mentioned this last time. An early discounted payoff is a big win-win here. And actually, if we had achieved that lower discounted payoff of $3,388, it would have been a higher internal rate of return because that was within like 3-4 months of acquisition. So to wait an additional 5 months to get to that $4,000 DPO actually did not offer a higher internal rate of return. So time value of money is super important. It actually turned out to be 137% net IRR at the end of the day. It would have been higher still at $3,388 if it was achieved in 4 months. All right, one more case study, and then we got to wrap it up. It's almost 11 here. This one's a non-performing second lien secured by a single family home that was achieved a modification agreement at the end of the day to result in a reperforming loan value of $25,125. So the fair market value on this was $489,500 with a senior of $410,780, which results in $78,720 of equity, protecting our unpaid principal balance of $31,046. Plenty of equity here. This is a top tier asset other than the senior status. So let's look at that. What happened? Where are you now? And what do you want to do? The borrower hit a rough patch. They were self-employed and their business was kind of going downhill, and they actually got behind on their first and their second lien. So they were 60 days late on the senior, but they were working to bring it current, and their business was picking back up again, but they couldn't pay more than the original $352 monthly payment. And so we agreed to a payment plan back in January, and then this borrower disappeared for months. We renewed the conversation again in July, and they agreed to a $1,000 down payment plus $350 per month. And we ended up getting a fixed rate loan mod in place for around 6% interest, a little less than 6%. We actually started this conversation at 8.75%. And that's normally the standard interest rate that we're charging, since these are non-performing borrowers with pretty rough FICO scores. But when we get into a negotiation, that's one of the adjustments that we can make to make the modification attractive to a borrower, is to reduce that interest rate a little bit. So we bought this loan for $9,500. That's 30.6% of the unpaid principal balance. It's a pretty good deal considering the equity position. The reason it was less than a really high tier second was because the senior was 60 days late. And when you look at a trade line that's going downhill, you don't know whether or not that borrower is going to stabilize and figure out a way to pay it, or if it's going to continue down to a lower equity position as the senior balance increases and arrears and legal fees mount. But in this case, $9,500, it took 10 months from acquisition to disposition, which in this case was a modification agreement, $340 of expenses to analyze, onboard, collect, and then pay a mod fee. So this offers a 16% cash-on-cash return to a reperforming loan buyer. So at $350 a month, if you bought that debt for $25,125, you would achieve 16% cash-on-cash return every single year. It's 100% plus internal rate of return for the non-performing loan buyer who did this fix and flip strategy. You buy it for 95, you put 340 into it and your time to get to the mod, and then you flip it after seasoning for $25,125. You've achieved more than 100% internal rate of return on your money. So some takeaways on this account. One, present your options as non-negotiable, but then allow some flexibility when you can. You don't want to present an option and be really soft on whether or not that option is set in stone, because a lot of the borrowers that we get modifications done with, we don't even have any conversation about the rate. 8.75% is the rate. That's what you're going to pay. There's no negotiations, and it works. But if the borrower does push back and you need to adjust a little, then that's where you can start to negotiate, get a rate that makes sense and makes them feel comfortable with paying that loan for the entire term. Now, here's a good one. It's good cop, bad cop. The good cop is a resolution specialist. That's the person who's actually communicating with the borrower, presenting the terms, getting the deal done. And the bad cop is the investment committee. So you want to have a third party. Maybe it's imaginary, maybe it's you, an alter ego, but the investment committee, they're the ones who are going to say, no, we cannot pursue that deal. We need this. And then the resolution specialist goes to the borrower and says, hey, I went to bat for you. We're really trying to get this deal done, but unfortunately, the investment committee, they can't offer any less than this. So by aligning yourself with the borrower and having that investment committee as the bad guy, you guys are on the same page, working out the borrower's finances together. Next is to respect the borrower's need for authentication. If they want the assignment of mortgage and the note and the payment history, and it's called a qualified written response, a QWR, means the borrower wants to see all the docs, you got to provide them, then you need to respect the borrower's need for that. Don't scoff and kind of write it off. Provide those documents in an organized way so the borrower can see that it is a legitimate lien that they need to address. And then finally, communicate professionally, solidify legitimacy. This borrower was very interesting because they did not want to communicate through email or phone. They did eventually once we built the rapport, but they wanted everything through the mail. And by the way, they were, this is crazy, but they were suspicious of FedEx. And unless it was USPS, they were concerned with the legitimacy. So we needed to send the modification agreement and all of the emails that I printed out and included in a USPS shipment to the borrower so that they would see that it's legitimate. We have an address in the country and we're, the licensed lender servicer team to get this deal done. So definitely solidify your legitimacy as a note investor. Make sure you have a solid website, you have the mini Miranda in your email signature, and you're communicating as professionally as possible. All right, so that is it for the case studies. We've reviewed first and seconds, pricing, due diligence. Thank you so much for watching, guys. I didn't see a lot of questions other than the ones we actually addressed. So please, I guess you guys got to go to your next session here. Please tune in again. I'll be on again at 2 for a more conceptual show. This was a bit technical, first versus seconds. My next show is more conceptual with finding your niche in notes and then creating a business where you can learn this industry while actually earning money in it. So please tune in for that at 2 o'clock. Oliver, thank you so much for coming. And yeah, thank you for subscribing to the Fixed Notes channel. It's every single week on YouTube. I present an industry topic, and if you leave comments there on YouTube, you can kind of direct what you want to learn in a future episode. Totally free. It's about an hour-long show, and it's kind of fun because we do a little bird watching, and I have the fish pond out back. We feed the fish at the end of every show, so it adds a little bit of personality, a little bit of fun, in addition to all of this mortgage note content. Thank you, Ed. Fantastic. Yeah, appreciate you guys being here and enjoy this conference. It's going to be a great event. Like I said, I'll be back at 2. I'm actually in the private room, I think, so you'd have to pay for the admission to go to these other sessions. So 2 o'clock, if you want to be there, make sure you subscribed, you signed up for the full access to this conference. And of course, check out the note investing course, fixednotes.com/learn. And then the news aggregator, fixednotes.com/news. You can see the latest in the industry. Thank you again for watching. I'm going to close it down here because you guys have another session to go to. And once again, definitely check out the Be the Bank show for all this content, industry overview, tech tips, vendor reviews, assets for sale, case studies, giveaways, and more on Be the Bank every single Wednesday. This was a blast, guys. Thank you so much for tuning in again. Really great to meet all of you, and I would love to connect in more detail over at the YouTube page or on Facebook or wherever, whatever platform you feel most comfortable with. I probably prefer email, so feel free to email me. You can find my email address on the website, or if not, it's robert@robbymax.com. You could also send an email to the Fixed Notes email. I think it's support@fixednotes.com. Be happy to respond to you however you best communicate. So thank you for joining us, and please tune in at 2 o'clock. We're gonna call it a day here. I think I just have to press leave studio. All right, see you guys.